Hey everyone, hopefully you're having a good day. My name's Andy. My channel is Finding Value. We're going to rip through Twitter, see what people are sharing on social media related to three different topics: wealth building, commodities, and/or financial topics. I'll interject my financial opinions as we go through it, and let's see what people are sharing. If you want to follow me, it's at Finance. If you want to join our community, finding-value.com. I go through a whole bunch of stuff, looking for potential investment opportunities, sharing what I'm doing. And we do have a Black Friday coupon code that is active if you want further savings. That yearly membership is looking juicy with those savings. So Tracy says, no demand, they say. World's top oil refining hub is running hard as exports boom. So the U.S. Gulf Coast refineries are running the hardest for this time of the year in more than 3 decades as they rush to take advantage of strong fuel demand from Mexico and Brazil. Fuel makers in the world's largest refining hub processed 9.31 million barrels of crude a day last week, the highest for this time of year in data going back to 1992. According to the Energy Information Administration, the U.S. is on pace to ship about 3 million barrels of products, including diesel and gasoline, a day this month, the most in more than 7 years, according to maritime intelligence firm Kepler. What does this mean? Well, it means that demand is high, and it also means that our tankers might be shipping some stuff around the world. That's what it means. And that's why I'm sharing it. There is no demand problem. And I know people who are looking at the technical charts and saying that oil is bearish. I don't know about that. That's not what the physical markets and the inventory levels are suggesting. Now, does that mean just because the physical markets today means that the oil price should be going up? That's not exactly what it means. Investors are looking out 12 months to 18 months ahead and trying to price today what could be coming over the next months. And that's where things could get a little bit muddy. We could be strong today, but we could be weaker tomorrow, if that makes sense. And maybe that's why we are at where we're at. But I will say this: oil is incredibly cheap. It is priced at 1 ounce of gold to about 36, 37 barrels of oil. That's incredibly cheap historically. So buying at this time and holding through thick and thin will prove to be a very good idea, I think, because of the valuation that we're at. Peter Sutherland says, very nice top line crude draw on tap for this week and a counter seasonal to boot. But remember, just because the phantom oil glut fails to materialize in data or spreads, it must not be questioned. Perhaps the phantom oil glut has truth in a broader philosophical sense, and he's obviously joking. Where is this oil glut that we've got? It's phantom, it's hidden because we don't have one. That's what he's saying. Here's some more energy, and I like oil right now because it's so stinking cheap. So I said, it is coming, the great rotation. Are you ready for it? This is XLE divided by the NASDAQ Composite Index. What we see here is an expansion phase of real estate from 99 onwards. We had a recovery phase from 2009 all the way down to about 2019, and sometimes you get a little bit of momentum overlap. 2020 was the ultimate bottom. We have turned from that bottom. We've broken higher, and we are now in a falling wedge ready to break to the upside of the energy ETF versus the NASDAQ composite. If you look at the commodity to stock ratio, we went upwards from 98, 99, all the way up to 2008. At the beginning of this one, we bottomed at 2020 and we've been heading higher. That just so happens that 98, 99 was the bottom here, and we headed all the way up to 2008. We reversed, and then 2020 was the bottom, and we're going to head higher here. Energy is going to outperform the NASDAQ coming forward. and it's probably going to be a very large outperformance similar to what we did before. And if you look at where we are today, we are at the beginning of the last bull market in 1999, 2000, where this also bottomed and worked our way on up. That's how cheap we still are today. We have an entire bull market ahead of us. And then looking at interest rates, the 10-year, this is what I think is going to potentially spark the move. When rates go up, that is when the money rotation starts to occur, is when rates get to a certain level. 5% is roughly where that level is, I think. And if they do QE, if they try to bring this down to save the NASDAQ, well, then we're going to get even more inflation. It's going to be a very big move in energy and a very big move in precious metals if they try to do that, which I think they very well could. That's what happened last time. Right here, they did that same thing right here. In about 2000, 2001, they started to lower interest rates, and then the dollar dropped. The dollar dropping forced all these commodities way up. The same situation is coming right now. We're going to go through it right here over the next 6 months, year or two, and it's all going to play out again, and then commodities are going to rip. That's the way that I see it. Clarkson's VLCCs, which is the larger tankers for moving oil, are now firming across the globe. What remains to be seen is if these rates can hold up over a sustained period of time, like we ultimately haven't seen these past few months of quarter four. I think he screwed that up. So we didn't see that the past few months. We've seen a lot of weakness in oil tanker rates, but things are firming up across the globe and they look pretty good going forward. So tankers are looking pretty good, in my opinion. They're paying a lot of dividends. So if you guys want to see, what my favorite companies are in the tankers, and I've been buying them, you can join the website. You can see those that I've been buying, and they've got dividends that are, 8, 9, 10 to 15% dividend yields. Big dividend yields. Nat gas is looking solid here. Want to know the best ways to play it? Obviously, join our community, but natural gas is starting to break out. It looks fantastic breaking out. That's a good spot to generally be looking at potential companies. I looked at it before when it was down here because I noticed that the lows were coming on up. We've got natural gas versus crude oil, and natural gas is incredibly cheap. If you see where we're at today, we are below the entire bull market, even under 1991. And that is underneath everything. So that means that natural gas is cheaper than every single year before 2012. It is cheaper right now than all of those years versus crude oil. And crude oil is super cheap against gold. So what we could see out of natural gas is a monster move. Like if we were to come back to this high up here, and I'm not saying we are, but if we were, that would be many fold increase because crude oil was also, actually crude oil at that time was still low, but if we come to this area up here, wherever it is, 0.25 is a huge outperformance against crude oil, and crude oil is probably going to go up from here. We got natural gas versus Dow Jones, and some people say, well, why would you compare these two? Well, it's the same thing that you'd compare commodities against financial assets. It's the same thing. And you want to be in the underperformer, which turns into an outperformer. So we broke out in 99, which is also the bottom of the commodity stock ratio. We had a nasty pullback in the beginning, and that was 2002. I think that 2002, 2001 is where we are today. That's what I think. So circle for circle. We broke out, and then we had a nasty pullback all the way back here, and we'll see if we run, which I think we will. Minor deck. So copper production for quarter three. We've got Freeport McMoran, the biggest copper producer. BHP Group's another huge copper producer. Codelco. This is Zijin Mining Group. Southern Copper, Glencore, KGHM, Anglo American, and then Antofagasta. The big boys producing copper. Investment wisdom from John Templeton. He says, people are always asking me where the outlook is good, but that's the wrong question. The right question is, where is the outlook the most miserable? And that's your ninja buying. You want to go where people aren't looking, and you want to go where things are bad so you can go buy the contrarian stuff. That's how you make money. It's that simple, guys. Like I don't know how I can convey that. It is that simple. You just go around, and when people are super excited about something, if Scottie Pippen is putting stuff out about Bitcoin and crypto on Twitter, that's not a spot where you want to be. That is not a spot. If no one is talking about something and everyone is like it's just completely off the radar, like tankers right now, that's where you want to look. Is anybody talking about dry bulk shipping? No. That's probably a great opportunity. And then after you make a 10x or 20x, people are then going to say, hey, didn't you invest in dry bulk and tankers? And you're like, yeah. And then they'll say, well, should I invest now? And then you just shake your head like, no, go buy something that like nobody's looking at, that everyone hates. That's where you make the money. Finding finance, he says, dream in a dream. So I've got this saying, a dream within a dream within a dream. And what that means is you've got a perfect technical setup on the long term, the medium term, and the short term. So it's a dream within a dream within a dream on all time frames. You can be bearish long term, bullish medium term, and bullish short term. You can be bullish, bullish, bullish. You can be bearish, bearish, bearish. And then you can have any mix between it. You can be bearish, bullish, bullish, bearish, bullish, bearish. And people do not understand that. They'll say, how come you're bearish on an asset? And you're like, well, that's on a different time frame. I'm bullish long term, but bearish short term. Because the cyclical, you could have a cyclical pullback, which is a short term pullback in a big secular bull market. So what he's saying here is this a dream within a dream for lumber? We've got a bottom here. We've pulled on up, and then we have another potential bottom here. And then on a shorter term, we also have a neckline. So this one is the medium term, a double bottom. And then on the short term, we've got a shoulder head shoulder that's broken out to the upside, working its way on up. And now we're up against resistance. So is this a dream within a dream? It is a dream within a dream. Now, what does the long, bigger picture view look like? I think we're on maybe a long-term support that runs across here all the way back. We'd have to see. But I don't know if it's a dream within a dream within a dream. But it does look good for lumber. And lumber is generally a leading indicator for the housing market. Heinrich says, Arctic temperatures fell to a record low for mid-November, lower now than the historic seasonal low in mid-December. This signals a cooling trend far below historic averages. This will give mild temps on continents short term, yet will pave the way for an extreme cold winter. If this materializes in an extreme cold winter for Europe, they are screwed. Like, natural gas prices are going to go vertical goose. Now, I don't wish that on anyone, but I hate to say it, guys, they haven't built the inventories. So the inventory is small compared to their flow rate. They need a lot. They need to double their inventory level, perhaps. But 30 HPA temperature over North Pole, it's been driving down. This could indicate that we get an extremely cold winter. It's going to be a huge demand for natural gas. And our inventory levels in America and the inventory levels in Europe, in terms of days of coverage, are not very large. What that means is that you can eat through your inventory levels very quickly. And it's going to put a lot of pressure on natural gas price. So natural gas price can be incredibly volatile. That's what it means. So knowing this information means that you can look at the markets. We just went over that natural gas is incredibly cheap. And now we know that we can position for this, because if this does come and we are positioned in natural gas when it's cheap, you kind of have all your ducks covered there, because you eliminate a lot of the downside risk and you've got a whole bunch of upside potential. That is asymmetry. That is what we invest for, the big asymmetry. It says, Ramet says, beware of the endless search for advanced tips. Sometimes the most advanced thing you can do is the basics consistently. Once you figure out how to invest, guys, it's just taking that strategy and deploying it over and over and over. It might take you 6 months to a year to really figure it out, or maybe even longer. Once you go through a couple of iterations, you figure out, hey, I need to buy it low. I need to have a time frame that extends outward, not measured in weeks or months, but years. Then you figure it out. You buy a bottoming pattern or something like that. You wait, and then you get many hundreds of percents gains. Once you do that a few times, it really is just basics. It's nothing, and you just deploy the strategy over and over. Warren Buffett says, what the wise do in the beginning, the fool does in the end, which means you buy when it's in the beginning of a trend, and the retail guys come in, the fools, buying it at the end. So watch what the retail guys are doing. Where are they located? Technology stocks and crypto. That's where they're located. There's the fools. And they're acting so foolish, in my opinion. Core trading plan, what's next? It says, don't think anyone's ready for what markets are signaling here. Some clear big picture signals, an important time with year-end approaching. This is the S&P tech sector, which could potentially be squeezing up and topping. And what we're seeing here, I think that's the relative strength indicator from 100. We're losing strength and momentum as this dips down. A very similar setup happened in 2021, and then we lost our super high intensity training and went down. So I think we're going to get another pullback. How big this pullback is, I don't know. How fast it goes, I don't know. No one knows that. There's a ton of people on Twitter that are going to let you know, and YouTube, what their opinions are on how fast and how big this will be. And they're probably going to put it out there, a 1929 crash and a 2008 crash. You know what I hate to say, guys? If they're saying that, they don't know what the heck they're talking about. Both of those crashes were deleveraging events from the real estate market. We are not anywhere close to a deleveraging event in the real estate market. So cocaine's a hell of a drug. They need to get off it. Terry Bros, gas storage fast depleting. That is what I'm talking about. So what does that mean? The days of coverage of inventory is not that big. So think of it as you got a huge V8 engine. It's a big 454 and it drinks some gas, right? Let's say you get 8 miles per gallon. Someone has fit this engine to an economy car, and the gasoline storage is only 11 gallons big, but you only get 10 gallons per mile, 10 miles per gallon. So that's 10 times 11. You can only go 100, let's say 110 miles on a tank of gas. The gas tank is too small. That's the same situation as the EU storage level. Their storage level for their flow rates is too small. So when they look, they're like, oh, it's going to be okay. We're at 97%. I'm like, yeah, but your storage level is teeny. If we get extreme cold, this is going to drop like a rock. It's going to drop like big time. So it depends highly on the weather here. And their small days of coverage could drop dramatically, and that's going to send prices to the moon. If that occurs. If that occurs. Award-winning technical analyst Tom DeMark says the stock market is approaching a top and compares it to 1929. Now, the only thing that I will say as a comparison to 1929 is maybe the length of the bear market afterwards maybe could be the same, but I just don't think it's going to occur now. I think it's still out in the future. And we need deleveraging. We need deflation in the system for this to be exactly like 1929. But there could be parallels, maybe. HFI research, if this happens, U.S. oil production will fall back to 12.3 and 12.5 million barrels per day. We will see a decrease of 800,000 to 1 million barrels per day. Canada will lose 550,000 to 750,000 barrels per day. And this is what Peter Brandt said. He said, crude oil to the 40s, chart suggests that is possible. The only thing that we got is we got a huge bullish engulfing today, which means that is a reversal candlestick to go higher, not lower. We'll see what happens. Okay, so I agree with Ron Rule here. I want to read this real quick. He says, property taxes should be outlawed. And before someone says all taxes should be outlawed, yes, but property taxes in particular are the most unjust. Every other tax is based on a share of a transaction. You always know upfront what this share will be, outside of maybe healthcare, guys, because healthcare, I don't even know what they charge before I go in there. Further, property taxes, on the other hand, are based on a value assessed by the same entity levying the tax. Your town or county literally decides what your property is worth, assesses the value, and then demands a share of it, regardless of your ability to pay. Fail to pay, and they take the property for themselves. The model is actually worse than an unrealized gains tax. You aren't just paying the tax on the gain. You are basically paying a percentage of whatever they decide the value is every year in perpetuity. That's why it is the most unjust tax. That's why it should be abolished. And I agree with that. And here's another thing that I don't like about property taxes. Property taxes, so when you buy a house, the house is a house. It doesn't go up or down in value. One house equals one house of that size and make. Now, some people say, oh, the value goes up because you live in a desirable location. Maybe to some degree, yes. But here's the thing. The majority of the price moves are done because of inflation. So inflation is increasing the nominal price of your house. And then they get to tax the nominal price on the house. I disagree with that. Now, I would agree that the taxes should have limitations to them. So maybe it's a certain percentage when you buy the house, and then maybe they cannot raise it every single year greater than a certain percentage. And they did this in California. California, they can only raise it a certain percentage, like 2% or whatever it is, per year. I would agree with that because then you know what you're getting into. They can't tax you out of your house, basically. And the person can basically state, I know what my taxes will be over the next few years, and you can plan for it. Right now, if home prices go way up, it's like you can't really plan for that necessarily. Is the ability to simplify a mass amount of information into a simple yes or no decision, and that is exactly what we do in the stock market. That's exactly what I'm doing every single time I make a decision to buy a stock or sell it eventually. Bob Coleman says Bitcoin, Tether, Wall Street, US Treasury debt. Part of being a good analyst and advisor is the ability to stay objective and report the truth as one sees it. Today's world is filled with socio promoters. These are social media influencers, promoters, article writers, and Wall Street players who cheer, lead, and look for biased confirmation in order to make money from their followers and investors. Since the crash of 1929, financial reforms were put in place to protect the public. Unfortunately, We are repeating the stock operator days of the 1920s. If one understands what the Bitcoin ETFs are about and analyzes the relationship with the BTC mining industry, it is not hard to realize this is either the largest Ponzi scheme in the history of mankind, or Wall Street is driving and creating a digital industry to fund the US government deficit spending. No other mining industry holds back almost all of their production and penalizes their investors with massive stock dilution, hoping the Bitcoin price rallies. This practice of withholding the sale Bitcoin production is a form of market manipulation. To do so is attempting to hide the massive losses these miners are incurring. At the same time, the sole reason of withholding production is to dry up supply in order to drive the Bitcoin price higher. This is where Wall Street and its promoters come into the picture, promoting debt and equity issuance to increase the volume of Bitcoin trades in order to manipulate the price higher with the sole purpose of creating the illusion of value. Then creating ETFs to legitimize the product for public consumption, similar to the COVID vaccine shot. To complete the circle, Tether and other stable coins act as conduits for attracting money to support Wall Street's true intention of finding new buyers for billions of dollars of new supply of US Treasury debt. That is what's going on with crypto, in his opinion, from Bob Coleman. I love it, guys. Down, emerging markets ex China, a big breakout. So emerging markets are breaking to the upside, and I think this is a good to be exposed to. The big bull market here is from the dollar declining. We had a first move, the pullback, and then the big move. This is the big consolidation, and we've broken out of the consolidation, just like oil has. Oil's got the same chart, got the same stinking chart. So does ExxonMobil. So does Chevron. So does all the big companies. All of them, they'll have this. Same thing. And that's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website if you are interested. Black Friday coupon code. Get the savings for the yearly membership. And that's all I've got for today, guys. So we'll catch you next time. This is Finding Value.